Fed Chair Powell announced the central bank's 10th straight rate hike yesterday, raising rates by a quarter point, the highest level in 16 years, signaled a possible pause at their next meeting in June. For reaction, let's bring in Roger Ferguson, former vice chairman of the Federal Reserve, former CEO of TIAA, and a CNBC contributor. Thanks for joining us, Roger. You know, you would think that, I mean, you're on quite a bit, and we never run out of new things that can, you know, add or to the discussion, add to our anxiety, that take away from our anxiety. So now you got PacWest today, you saw First Republic. So everything the Fed's doing that we've talked about in the past, it wasn't whether we were worried about the financial system and possible effects, and now it is. Do you, Steve Leisman, asked Jay Powell about that yesterday. Do you think they're taking that into account enough at this point, the stability of the overall system, what could happen?
Look, thanks for having me on. I heard what Chair Powell had to say yesterday in response to Steve and others. And I think what they're trying to do is difficult and may not be working. They are trying to separate out the need to control inflation by raising rates. It's the only tool they have from the question of financial stability. And they're arguing that their bank oversight tools are working very well. And they have a point of view. I'm not sure everyone agrees with it, and I'm not sure I do, that the banking system is overall stable. I would say certainly, you know, the banks are well capitalized, but we see a lot of anxiety around the small and medium-sized banks. And I think to some degree, you know, they're not focusing in on that. Now, let's be very, very clear. You know, their first job is inflation. They're worried about that. But I do think they could be more nuanced and more subtle in their communication and maybe give a little bit more nod to and recognition of the strains in the financial system and not simply say that, you know, everything is fine, because the evidence from the market at least is there's anxiety.
Yeah, and you make a good point, Roger. At least I thought while you were talking, I thought about this. So raising rates works for inflation, obviously, but it just seems like, you know, it's a blunt instrument. You hope 25 basis points somehow hurts demand somewhere that eventually ends up with, you know, less inflationary pressure and adds to that. But it seems like I say, a blunt instrument, and you don't get 100% for your money. You might get 20% of the effect. But when you're doing it to the financial system, it can be a multiplier effect. I don't know what 25 basis points does when you have all these institutions with duration risk. So that's a real 25 basis points there. It just seems like you don't get much for your money when you're working on inflation, but you can really do some damage if you're not careful.
Well, that's exactly the dilemma they're confronting, right? So they've raised rates at a historically rapid level. Powell yesterday clearly pointed out that rates are in restrictive territory. We're starting to see the real economy slow, i.e. job market maybe loosening up a little bit, growth slowing, as we talked about the other day. Unfortunately, inflation is still sticky. And I think they're caught a little bit between, you know, the dilemma of inflation that is only gradually moving towards 2% and the kinds of impacts that rising rates have had in the housing sector, overall in demand, and obviously in the financial services area, in the banking sector. So, you know, that is unfortunately their dilemma, and the only tool that they have is really a blunt one. And so, you know, all the more reason for them to signal, as they did yesterday, a pause, and to signal that the future will be, you know, as he said again, very, very data dependent, including taking into account changing liquidity conditions and changing credit conditions based on these stresses in the banking system.
Roger, I know that the Fed historically has not cared about stock prices, but when it comes to the movement and the trades in regional banks, which we're seeing decline across the board pretty much this morning, and they decline on the heels of Chair Powell's press conference, shouldn't he be concerned? I mean, those equities are part of the bank's capital structures. And so we're seeing today with PacWest down by 45% pre-market, and the worry is spreading to Western Alliance and others. I mean, I'm just wondering if we should start thinking about a banking crisis in a broader term. It's not just the too big to fail banks, but if you have a number of regionals, doesn't that impact sentiment? Doesn't it impact credit? I mean, in many ways that are very harmful to the economy.
Melissa, I agree with you. I think we heard him nod in that general direction yesterday without being as explicit or as concerned as you are, and to some degree, I must say, I share your concern. So yes, I think they should recognize that the equity markets are saying there are significant stresses in parts of the banking system, not in the very, very large ones, but in these medium-sized regional banks. They talked about the fact that will have an impact on credit conditions, which they want to continue to monitor, which I think obviously is right. I think where they haven't gone, and they probably are not going to go to the place of saying, at this stage, we're thinking about cutting rates as a result of this. You heard him say very clearly yesterday that the market expectation of a rate cut in this year was not his base case. And so I think they are observing, they're commenting, but I'm not sure that it's driving them yet to action because of the dilemma they have with inflation.